Japan's earnings season is kicking into high gear and investors are already popping the champagne. The stock market has jumped more than 20% since mid-November on confidence Prime Minister Shinzo Abe's pro-growth policies will translate into better times for the country's struggling companies. But is the rally overdone? Here are some factors to watch as the results come rolling in. Number 1, impact of a weak yen. The Japanese currency tumbled against the dollar in the 3 months through December, and that's set to bolster the bottom lines of exporters, which account for around 60% of listed firms.
Most of the Japanese domestic manufacturing operates at a yen-dollar rate of around about 85. So if that's the break-even, I think for a lot of the Japanese companies, they're going to start to see their earnings numbers climb because they're very, very large leverage to that.
Number 2, consumer electronics comeback. After a raft of dismal forecasts and profit warnings, all eyes will be on signs of a turnaround at tech giants like Sharp and Sony. Thomson Reuters data shows earnings momentum. One measure of expected earnings growth for the electronics sector stands at 4% versus minus 15% a month ago. Major investment banks have upgraded Sony's ratings, citing the weaker yen and the firm's solid restructuring efforts. Number 3, China. China is Japan's biggest trading partner, but tensions over disputed islands in the East China Sea late last year prompted many Chinese to boycott Japanese goods. This earnings season may provide the first signs anti-Japan sentiment is easing. Sales of Japanese cars in China are still falling, but at a slower rate. And with China's economy picking up steam, there are likely to be better months ahead. So as Japanese stocks skirt multi-year highs, it'll soon be clear whether the optimism is supported by numbers or just investors being bubbly.